In the last lecture, we discussed about exchange rate in the long run. We saw how purchasing power parity theory of exchange rate doesn't hold up with real life data. So that brings us to the next topic, which is exchange rates in the short run. Before we go into details of exchange rate in the short run, let's try to understand how is foreign exchange traded, or how the value of the foreign exchange is determined in the foreign exchange market where foreign exchanges are traded. First of all, foreign exchange market is organized as an over-the-counter market. Now, what does this over-the-counter market means? So over-the-counter market is a decentralized market in which market participants trade stocks, commodities, currencies, or other instruments directly between two parties and without a central exchange such as stock exchange or broker. So essentially all the foreign exchange transactions happen between or among the traders or dealers. There is no centralized market for foreign exchange like the stock exchange, which is traded in the stock market most of the time. Main dealers in this market are the banks. So banks are the main traders. Most trades involve buying and selling of bank deposits denominated in different currencies. Remember, trade in bank deposits can be viewed as trade in assets, because when banks have deposits which shows up as liabilities for a bank, now often in banking they need to convert those liabilities into assets, and often by buying foreign exchanges they are holding a different kind of assets on the idea that they can hedge on that foreign exchange and earn some money. So primarily banks, through buying and selling of deposits in different currencies, they are trying to control the or determine the foreign exchange rate. Trade in foreign exchange market consists of transactions in excess of $1 million only. So if you are trying to buy anything less than $1 million, you can't be part of this over-the-counter market. You need to buy it from the retail market, like most of the people do, like a foreign exchange bureau, something like Travelex you might have seen in most of the airports in the United States. And finally, common people buy foreign exchange in the retail market from dealers such as American Express. So American Express in the United States is one of the biggest retailer of foreign exchanges. For if I need money, suppose I'm traveling to Europe, I need to go to a bank like American Express or a foreign exchange selling company like Travelex to convert my dollars into euros before I leave for Europe. Before I go into details of how foreign exchange markets determine the foreign exchange rate by selling and buying of assets, let's talk a little bit about some of the definitions so that we are on the same page. First definition is about spot exchange rate. Often in the popular literature, you hear about the spot exchange rate. What does it mean? What is a spot exchange rate? This is the current price level in the market to directly exchange one currency for another. And these are primarily determined by foreign exchange transactions among banks. So banks, through their transaction in foreign exchange, which has to be at least of $1 million for each transaction, they determine this spot exchange rates. There's also something called forward exchange rate. This is the exchange rate that is quoted and traded today, but for delivery and payments on a specific future date. So that's why it's called future exchange rate, where you decide on a particular rate today, but the actual exchange or transaction in assets is going to happen in future, but it will happen in the rate at which it is determined today. There's something called buying rate as well. Retail market, the buying rate is the rate at which money dealers will buy foreign currency. So when we talk about buying rate, is the dealers in foreign exchange at what rate they would be buying this currency. And there's a selling rate. So in the retail market, the selling rate is the rate at which money dealers will sell foreign currency. Again, these two are the retail market. where most of the people with a foreign exchange requirement of less than 1 million do operate. And often there's a gap between a buying rate and a selling rate. Mind you, for dealers in these foreign exchanges, they want to keep a margin, and that's why most of the time selling rate is often more than the buying rate. And the difference between selling rate and buying rate is the margin that all these dealers get to keep as their profit. And that's what exactly happens in the foreign exchange market. If you deal in foreign exchange market, you try to buy it as cheap as possible and sell it at the highest price it is possible, so that you can keep the rest as your own profits. Now let's come to the understanding of how these exchange rates are determined in the short run. And they're determined using a model of demand and supply analysis. Now, here obviously we're going to talk about demand and supply for foreign exchanges. And when we talk about demand and supply for foreign exchanges, we are primarily talking about demand and supply for foreign assets. That's what we are talking about here. And exchange rate is the price of domestic assets in terms of foreign assets, which we all know by now. So we will be using the theory of asset demand. So what does it mean? It means that for banks, if they're holding, say bank is holding a dollar deposits, and the foreign bank comes and they try to buy those dollar deposits, obviously foreign bank will be paying in some of their domestic currency. Say that foreign bank is a bank in France which deals in euros. So that foreign bank has to pay in euros, and the US domestic bank will be willing to sell the domestic assets and get that euro. That's how this is done. Now, why these banks will try to trade in those assets? Again, it all depends on the expected returns on these assets relative to each other. So what matters is this: what's their expectation of returns in each of these assets. Often traders in the foreign exchange market do make this kind of hedge investments. So let's get into details of this domestic demand and supply for domestic assets. Let's start with the demand for domestic assets. And here, when we say domestic, let's think about domestic is our US. And let's assume foreign is euro assets, just for the sake of clarity. So demand depends on the relative expected return. If I expect that tomorrow euro assets will be more valuable, I'll try to buy as much euro assets as possible today, so that in tomorrow when your value of the European assets increases, I can sell them at a higher price. And vice versa for the European banks. If European banks expect the value of their assets is going to go up, they will try to sell all their assets and try to buy more of the euro assets, with the expectation that they will be able to sell those assets in future to earn more profit. At lower current values of the dollar, everything else equal, the quantity demanded dollar assets is higher. If the value of dollars is lower and the buyers of the assets think that the currency is undervalued, so they will try to buy more of this American assets because they can buy a lot of it using a lower value of the dollar. Now let's think about the supply of assets. Again, when I say supply, it's the supply of domestic assets. And what are the supply of domestic assets? These are the amount of bank deposits, bonds, and equities in the United States, mostly held by the banks. And we also assume that supply will be a vertical curve, that is, supply of domestic assets are inelastic. What is inelastic? It means that it does not change with the exchange rate, because can you imagine how many times it happens that you go and deposit more money in your bank based on how much the dollar rate is? Obviously in the US we don't operate like this. It's the part of the big banks who kind of carry out all these transactions. So let's try to understand how the equilibrium in the foreign exchange market is achieved. For that, we have to develop a model of demand and supply. So what we'll do, so let's start with, so on the vertical axis, I'll measure exchange rate. An exchange rate here is euro per dollar. It's very important, that is how you measure these exchange rates. Here, euro per dollar, where dollar is the home currency or domestic currency and euro is the foreign currency, and all assets are in terms of dollar assets. So on the horizontal axis, I'll measure quantity of dollar assets. So that means assets which are denominated in dollar. Now there's a supply of assets. So as I said, supply of assets are fixed. Now this is supply of dollar assets. That means assets which are denominated in dollar. And there's a demand for assets. The demand for is downward sloping, which is demand for dollar assets. Now again, why demand for dollar assets is downward sloping? Because if the value of the dollar now higher, here it is, this is higher the value of the dollar. That means if the value of the dollar is 1.05, which means that $1 can buy 1.05 euro. What it shows, there is a demand for this asset is only about here, let's call it Q1, but the supply is here, we call it Q star. That means the demand is lower because they know the currency is very highly priced. On the other hand, let's say the value of this asset is 0.95. In this case, if the market believe that the value of the currency is undervalued, that means now dollar can buy very less of euro. That means currency is undervalued, where there can be a, which means this can be more demand than supply. So obviously the market needs to reach an equilibrium. An equilibrium is reached at this point where you may say it can be equal to 1, which essentially means that 1 euro equal to $1. And let's call it point B. So this is your equilibrium rate. So at this rate, the demand and supply of assets, which is the dollar denominated assets, are equal. So what you see here, higher here it is, higher the value of the dollar. So more it goes up, higher is the value of dollar. Go down, lower the value of the dollar, lower the value of dollar against euro. And because of this, the demand and supply of dollar assets, wherever they meet, that's where your equilibrium shows up. So let's try to use this concept to see what happens when certain things changes. So let's take a case where there's an increase in interest rate. And when I say increase in interest rate, there's a, say, increase in US interest rate. So US interest rate increases. So let's try to understand what is going to happen using a demand and supply for dollar assets. We'll try this. So this is your exchange rate, and this is your euro per dollar. This is your quantity of dollar assets or dollar denominated assets. This is your supply of dollar assets, and this is your demand for dollar assets. And mind you, what are this asset? These are most of the time deposits of the banks. Now think about this, and let's say this is the current equilibrium E star, where say exchange rate is 1, which means that 1 euro per dollar. Now there's an increase in the domestic interest rate. So domestic interest rate increases. That means any deposits in the US started earning higher interest rate. If that starts happening, what does it mean? That means the returns on domestic assets just went up, especially deposits. What foreign banks will try to do? They'll try to buy many of these deposits so that they can earn higher returns. So think about if you are in France and you are holding assets in euro, and you see that in US banks started paying higher interest. What do? Sell all your euro assets, take the euro, buy some dollars, and when you buy the dollars and you put it in a US bank, those becomes US assets. So what happened? The demand for US assets increases. So demand for US assets increases. It shaped right. So it moved from here to here. So demand, it increases due to increased return in US. So as a result, what happens? The exchange rate increases. Maybe it goes up to say 1.5 euro per dollar. What happened here is essentially the dollar just appreciated. So when domestic interest rate increases, domestic currency appreciates. So currency or value of the domestic currency, in this case dollar, just increased because of increase in the interest rate in the United States. Let's see what happens. The same thing when we talk about increase in foreign interest rates. So foreign interest rate increases. So you can imagine that it will move just in the opposite direction. Now suddenly all the deposits in the US banks is not that profitable. So if I'm holding US deposits, what I'll do, I try to sell those, buy some foreign currency, say euros, and put my money in euro rather than here. So what will happen here? Let's again start with demand and supply. And I'll measure, this is euro per dollar. This is quantity of dollar assets. So this is my supply of dollar assets, and this is my demand for dollar assets. And equilibrium is here, let's say at 1 euro per dollar. Now what's going to happen? As I said, if the foreign interest rate increases, that means interest rate in Europe is going up. All the people who are holding dollar assets will try to sell it off and put their money in the European banks. So as a result, what happens to the demand for domestic assets? Demand for domestic assets is going to decrease. So demand for domestic assets shifted left. So there's a decrease in domestic assets, which essentially means that your exchange rate is going to go down. Maybe it becomes 0.8 euro per dollar. That means dollar depreciated. So increase in foreign interest rate leads to depreciation of dollar. So the value of the dollar is going to fall because people will be sending their money to European banks. Let's do one more exercise where we'll talk about increase in expected future exchange rate. So what you are expecting here that in future your domestic exchange rate is going to go up. That means tomorrow say the exchange rate or the value of your dollar is going to go up. If value of the dollar is going to go up tomorrow, what you do today? You will try to buy as much of domestic assets or dollar assets as possible because you want to convert any of your euro assets into dollar because those things will be more valuable tomorrow. So the idea here is that your demand for domestic assets will go up today on the expectation that tomorrow the value of your dollar is going to go up. That will lead to the increase in the value of the dollar. So let's try to do it using demand and supply for domestic assets. Again, we'll do euro per dollar. This is quantity of dollar assets. This is your supply of dollar assets. This is your demand for dollar assets. And so let's say equilibrium was at 1 euro per dollar. Now because of expected increase in future value of the dollar, so what's going to happen, your demand for dollar assets will go up today. So demand will increase. And as a result, we'll reach here where your exchange rate might be again 1.4 euro per dollar. So your dollar is going to appreciate today because of the expectation that it's going to go up tomorrow. So increase in expected exchange rate will lead to increase in exchange rate. And all this can be explained by the demand and supply of domestic assets. So next time you do this exercise, just draw this demand and supply graph and try to see what happens under different conditions if your demand for domestic assets changes. Most of this time supply will not change. It's always the demand, relative demand for domestic assets and how it affects the exchange rate in the market. And that's how the exchange rates are determined in the real world.